Hello listeners, and welcome to the Montel Weekly Podcast, bringing energy matters in an informal setting. Only a couple of weeks ago, the European Commission launched a 3-week consultation on its market design proposals. There have been several calls, and not only in Southern and Eastern Europe, for a change to the current marginal pricing model, where the most expensive power plant sets the wholesale price. What's on the table, and what will the consequences be for the way energy is bought and sold? Is a radical restructuring of wholesale markets needed, or even desired, or will such moves hamper much-needed investments in the energy sector? Helping me, Richard Sverrisson, to discuss these issues and much, much more is an expert on market design and energy markets, Stephen Woodhouse of Afry. Welcome back.
Richard, thank you for the invitation. Always a pleasure to discuss market design with informed people.
Perfect. Is the consultation from the Commission perhaps a recognition that something is wrong with the current market structure? Is it failing or dysfunctional?
The market is not failing, and the market is not dysfunctional. But if your objectives for a market are the efficient dispatch of electricity resources, including networks, it's working perfectly well and it's revealing scarcities. If your objectives are to do with welfare, distribution and national level reliability, it's perfectly easy to argue that in some places those objectives are not being met by the operation of the market. So, as always, people have different expectations of what a market is intended to deliver.
So, von der Leyen promised deep and comprehensive reforms last September, when we last spoke on the issue, actually, Stephen. What are your expectations here from the results of the consultation?
Well, this consultation reveals a lot of indecision. If, like me, you start from a market's perspective, believing that energy markets in the long run deliver the best outcomes for all of the actors, there's a lot here to be positive about. However, if you believe that markets for something as basic as electricity are fundamentally, wrong, and there should be interventions to deliver public outcomes rather than market outcomes, you can also read a lot into this document that supports your point of view. So the underlying objectives are set out sort of in the headlines: making electricity bills more independent from the cost of fossil fuels and carbon. That's a relatively short-term objective. Continuing to drive renewable investments, alternatives to gas to balance the system. They draw upon the long-term market interventions and question whether those should be continued, but they also then talk about better consumer empowerment and protection, and that extends to protection against market manipulation. So those objectives are set out reasonably clearly, but then the mechanisms to achieve those objectives range from things which are pretty market-based to things that are pretty non-market-based, and there's room for a lot of space in between. It's an interesting consultation as well. They set out questions, but it's very light on discussion and context about what they mean by those questions. So you can read quite a lot into certain things, perhaps more than was intended.
If we start with the first point there, Stephen, that you mentioned, so shielding consumers, both households and industrials, from high fossil fuel prices and carbon prices, is that hinting at, that they're looking to revise or review the marginal pricing system, that perhaps that they're looking for alternatives, and what could those alternatives be?
I didn't read that into this. As I said, there are lots of ways of interpreting this document, and there's not a lot of background discussion. But it struck me that the means of achieving that separation, as we get more and more renewables into the system, more and more of the energy in the market is not price setting. So there's a substantial amount of inframarginal rent, and we're expecting, under all circumstances, the price of gas and carbon to continue setting the marginal spot price for quite a long time. There have been various ideas floated to break that link, including separation of products, so you end up trading dispatchable and non-dispatchable, or green and brown power. You can cut it in different ways as almost separate products. The way they're proposing to do that here is not to split the spot markets, but rather to put some kind of long-term contractual arrangements on the renewables, whether it be in the form of contract for differences, two-way contract for differences, which is the form of support in Britain nowadays, or alternatively bilateral long-term power offtake agreements, PPAs, for renewable generation. So I don't read that they're trying to interfere with the underlying price formation, and which is, as we know, is also used for the flow of energy around Europe's transmission networks.
When we last talked, Tim, we went into quite a lot of detail about the marginal pricing system, and you offered a very robust defence of that. But since then, it has come in for more criticism from certain quarters, or even maybe heightened criticism. But you then expect that this won't get meddled with in the reform package that's coming.
I don't see that as being a feasible outcome based on the package that's on the table here. It seems to me it's more about putting additional contracts in place around the edges than interfering with the underlying basis for pricing and dispatch and transmission flows. The Commission's position in the past on capacity mechanisms, which are also, if you like, taking a bite out of the overall energy-only spot prices, has until recently been that these should be temporary interventions, and their vision has been of an energy-only market. It seems that they have moved to a position of acceptance of capacity mechanisms, and this document does explore ideas about, rewarding flexible capacity or low carbon capacity within those mechanisms. You can see ways that could be done to enhance spot price formation, where you set those capacity mechanisms as options on the spot price. But you can also see that as a way of legitimizing, dampening the underlying spot price and the reflection of scarcity in the spot price, and the creation of separate, more stable long-term revenue streams around the edges. And I see the PPA movement as being, another part of that. It's not taking away the spot prices, but it's diminishing their importance.
But where does that put, if you place more emphasis on contracts of difference on PPAs, where does that leave the forward market? Is that, are you then saying, okay, we'll leave the spot market alone, but we'll focus in more long term on CFDs and PPAs, and not the sort of forward traded market?
Well, the Commission does recognise the potential impact on forward markets. The trouble with forward markets is you can't create them. It requires market participants and brokers or exchange operators to come up with appropriate contracts. But it seems to me that the legitimacy of the forward market has been challenged with the growth of renewables, because the basic products which are traded forward are baseload and kind of simple shapes. No generators produce those shapes anymore. Gas generators produce in the hours when it's not windy. So any kind of long-term forward contract requires you to buy back half of the power that you've sold one way or another. So we need to start developing forward products that better reflect the shape risk as well as the price risk. Now, okay, if you give thermal generators a substantial part of their revenue through a long-term capacity price of some form, they've got no need to trade that forward. If you give renewables a substantial part of their revenue through a long-term CFD or PPA, they've also got no need to trade that forward. But even merchant renewables, given the nature of the forward products, they're basically baseload or peak 12-hour blocks, it's very hard to commit to those types of delivery profiles forward in any case. So I think I'd argue that, the very existence of weather-dependent renewable generation makes it difficult to continue trading the forward products that we have at the moment. And obviously, as if renewables are a small share of the market, there's a high degree of correlation between the price the base load price and the capture price for whatever renewable profile you have. But as renewables grow in share, it's more and more the case that when it's windy in Northern Europe, the price is very low, and when it's not windy, the price is high. So the correlation between the baseload price and the value that renewables are worth on their own production goes bigger and bigger. So the ability to use the basis risk associated with our existing forward products gets pretty bad. So we need to develop some new products if we're serious about getting forward trading, as opposed to long-term contracts to be the basis for our forward markets.
So in a sense, what you're saying here is, if I interpret it correctly, is pretty much the death knell of the forward market as it currently exists, Stephen.
Well, we certainly need to complement the baseload products with some products that better reflect the price and the volume risk that the market participants face today. And that gap in products is one of the reasons why the forward market liquidity has been diminishing, because it's become less relevant to a lot of the parties in the market.
Absolutely. I mean, I think that it's a fascinating discussion. But there was also a lot or mention in the document about virtual trading hubs. What do you understand by this? I mean, there wasn't a lot of detail here. But what's your kind of take on what was there?
Well, what I do read in this document is that the Commission is still fully committed to an internal market for energy. And to the extent that products like PPAs and CFDs become important, and capacity as well, they want to ensure that those are traded cross-border. So they're very keen on suggesting that cross-border PPAs should be facilitated. And I personally would infer from that they would like there to be long-term capacity, cross-border or cross-zone capacity products made available. They also emphasise, when they're talking about getting flexibility from sources other than gas, that they emphasise intraday gate closure times and the availability of capacity intraday, so cross-border capacity intraday, which is a subject I've been working on for quite a number of years. They're also talking about creating perhaps standardized products for PPAs and maybe aggregating demands of smaller consumers to allow them to buy from PPAs. And again, creating liquidity in forward markets. They talk about these virtual trading hubs. Whether that would somehow be integrated with forward transmission rights, I think that's one of the things they suggest. So this is really about creating ways of making full use of the transmission capacity over all of the contract timeframes, not just spot. And I think that's one of the things, when we go back to, the third energy package in the target model, there was a huge emphasis on getting the spot, by which generally most people mean the day ahead time frame, working. And there was a little bit of a gap about the forward markets and indeed the intraday. And I think they're recognising that those alternative timeframes are important, particularly when it comes to the allocation of network capacity.
On to some other matters now, Stephen. Just briefly, I mean, we've had, proposals from Greece, from France. We've had the Spanish intervention, and revenue caps set across Europe at national level. Do you expect these to be extended?
Well, we are seeing gas prices coming back to rather more normal levels. And if I were writing this kind of paper from a more neutral standpoint, rather than talking about protecting consumers from the short-term cost of fossil fuels, you might at least talk about, hedging consumers and producers who are not exposed to the cost of those fossil fuels from the volatility. So it's not just a one-way protection, it's actually a volatility hedge. So I think that's probably a difference that I would have made if I were drafting this paper. So it's very clear that there's a lot of political pressure on this subject. So as we see gas prices hopefully revert to what we consider to be more normal, maybe the pressure for those short-termist interventions will diminish. I don't see them as being part of an effective long-term market because, as we all know, internal market for energy includes freedom of movement of capital. And if you start introducing national level revenue caps or price caps on individual technologies, you start to deviate very quickly from a universal market where people take kind of pan-European investment decisions. So I don't see those types of interventions being sustainable in the long term, but they do indeed open the door to an extension of those mechanisms. I think that will be determined by politics.
I mean, if we, speaking of politics, I mean, we discussed this a little bit before we started, Stephen, but do you see in the interventions that we've seen in Europe, but also partly in this consultation, an increasing role for the state and for national governments, especially, for example, in CFDs? That's often a national jurisdiction. So, I mean, is this a worry that we're kind of turning the clock back against the internal energy market and focusing more on what's best for national jurisdictions?
Again, there are markets and less market routes that are in the same consultation. And I think most people would agree that, some kind of state-backed support for the deployment of renewable generation is still required in most countries. I mean, Afry is just doing a market design study in Britain in response to the REMA arrangements, and it's a very similar set of challenges that we're facing. And if you follow my work for years, you'll know I'm kind of one of the last-ditch advocates of energy-only markets. And I wasn't particularly in favour of this move to the CFD from the renewable obligation because you divorce renewables from caring about the price of the product that they produce. But even in our own, we're coming to similar conclusions that really, in Britain, we're trying to decarbonise the power system completely by 2035. And the European targets are similarly aggressive. If you want to deploy that much capital, you probably need some state direction and some state backing to do it. The Commission is noting the risk of crowding out private renewable contracting by the CFDs, and they do talk about how to facilitate private PPAs alongside the CFDs. I mean, what they don't say, but you could certainly imagine, is that if you've got state-backed CFDs at some point, you might then auction those products off. And indeed, they also talk about some kind of state credit guarantee for bilateral PPAs. So they are exploring ways to, give states support without having full state control over those types of contracts. But if you read elsewhere in the consultation, there's a lot more about making markets work. So we're talking about developing non-gas sources of flexibility. And in that section, they double down on the provisions in the clean energy package, which ask for network operators to have TOTEX-style incentives so they can build non-wires flexibility solutions. But there's an emphasis there even on, better access of demand-side resources to deliver the flexibility services. And they even talk about sub-metering to allow certain resources to participate directly in markets. So you can imagine, if you just look at somebody's house, their consumption patterns are quite variable. But if you look at the EV charger in the house, that's a very controllable, directable, monitorable resource. So I was quite pleased to see the suggestion that there might be sub-metering available to allow some types of resource to participate more directly in flexibility markets. And indeed, we've been working with SmartN recently, and that's one of their recommendations. So I see a lot in this that does bring markets, not just rely on state solutions.
No, it's interesting. You're providing a secondary or tertiary market for those kind of renewable projects, whether CFDs or PPAs. I think that's an interesting direction. But if I'm a little bit curious about the timings here, Stephen. I mean, what do you think can be changed quickly and have an immediate impact, and what needs more time to agree on or implement?
Richard, may I just go back a moment? You were talking about the state role in CFDs and PPAs. There is one point to make here. I think there is a couple of, let me say, omissions, and I'm not sure if they're deliberate omissions or we're operating at a slightly higher level, but it strikes me that there are a couple of things in the CFD space that have not been discussed in this paper that perhaps could have been and might form part of the next steps. So on the one hand, there's quite a move now. Some companies buy PPAs and they meet their own renewable energy purchase obligations through the purchase of PPAs. Others still buy, some kind of certificates, REGOs. It's my understanding that the Trilogue has reached a position that the REGOs will have resolution of the settlement intervals, and let's say 15-minute resolution, rather than the annual resolution that they have today. So at the moment, most people say, I procure green energy, and they buy enough annual certificates to cover their annual demand. At some stage, we might see buyers of energy actually trying to match their profile of consumption with these certificates. And indeed, we've seen organisations like Energy Tag, and I think Eurelectric's got a 24/7 initiative, which is looking at creating a market for 24/7 certificates rather than the annual balancing. So it seems to me that's a way of allowing consumers and buyers of energy more say in how they buy their renewables. I think the other point to make about CFDs is Europe moved away from production-based subsidies, I think, in the 90s in the context of the Common Agricultural Policy. So, you can take your own views about how market-based or otherwise the Common Agricultural Policy is, but wouldn't it be nice if our energy market were more advanced than 1990s European Agricultural Policy, not less? But we still have production-based subsidies for renewable energy. And when renewable energy is at the bottom of the merit order stack and there's not very much of it, it's a bit like priority dispatch. It's an anomaly, but it doesn't have a practical impact. But once we move to a situation where renewables are dominating the market, it is no longer good enough that they bid at the negative of whatever contract for support they have. And it's no longer good enough that they produce energy when it would be more valuable for them either to stop producing energy, or maybe this is the same thing, or to sell reserve instead of energy. We are exploring models where you break the connection between the actual metered production of energy and the level of support payments. So there are various models out there, yardstick CFDs, steam generation CFDs. You could also look at kind of revenue caps and floors. But I think it's an omission that those types of alternative structures of CFD haven't been discussed in here. Now, we know the Commission doesn't support CFDs, renewable support mechanisms, where you get sustained periods of negative prices. So that a step had already been taken in that direction. But I think we could look at much better structures of CFD to minimise the impact on market distortion.
But Stephen, could I just ask you then to give an example of how one of those alternative use of CFDs would work in practice?
An example, there's been an example of this in force in the Irish single electricity market, which was introduced in 2007 when we looked at the calculation of constraint payments for wind. So basically, each of the wind farms had a real-time wind speed indicator and there was a power curve. So if you were producing energy to the max, your output was whatever your meter said. But if you were deloaded, there was a calculation made based on an on-site real-time wind speed indicator that calculated what your production would have been had you not turned down. And that could then be the basis for settlement. So you could use that perhaps as the basis for settlement of support payments, or you could use more regional averages. There are lots of ways you could do it. But the point is, you're based on what you could have produced, or, at either real time or based on some forecast, not on what you actually do produce. So your support payment is independent of whether you actually produce energy or not. So in the event that the value of the spot energy is negative, don't produce it. But you don't then forego the support payment for that period at the same time. So you could do this in lots of ways. You could give capital grants instead of per megawatt hour support, but this is a way of at least tying the support a little bit more closely to the capabilities of the plant, rather than it just being, much more lump sum based.
Makes a lot of sense. I think the discussion as well of REGOs or guarantees of origin is one where we could probably talk about at some length in and of itself. But if just to sort of finally talk a little bit about the timings here, in terms of the market design proposals and imminent potential or some changes to that structure, what can be changed quickly and have an immediate impact, and what do you think needs more time to agree on or implement?
The timing of intraday gate closure sounds easy, but I suspect that TSOs will find that that's a very, very difficult thing to change quickly, because they have a lot of processes that depend on cross-border flows. Absent a pan-European or a regional operational control centre, everything is still done on a national or subnational level. So those issues look simple and are actually complicated. If we were to explicitly allocate capacity towards the intraday time frame, I think economically that's desirable, and I know I've had debates with people about that. But again, the practicalities of that are quite complicated. We did a study for Insui a little while ago looking at what algorithms you might use for that. And it's by no means straightforward, because you're dealing with lots of alternative futures. PPAs and CFDs can be introduced at a national level reasonably quickly, but you're still talking years rather than months. As we know, interventions like windfall taxes and inframarginal rent extraction, those things have been implemented reasonably quickly, although I think the practical implementation issues are still challenging a lot of countries. Anything which fundamentally changes the mechanisms for price formation, and in particular, any kind of separation between products or even, the prices. I think, you've mentioned in other discussions about the prices within an area or the prices for export. I cannot see those changes being agreed quickly or even agreed at all. But if they were to be, the algorithms would be extremely challenging. So, we all know how complicated it is to unpick what goes on within the Euphoebia, I'm not sure it's called that now, and the XBID algorithm. So for intraday. So getting agreement on those things, I think, is likely to be quicker than actually the practical changes on the algorithms themselves. So I wouldn't see a lot of movement on the basics of price formation and energy flows very quickly.
Yeah, absolutely. I mean, I think just to sort of round off now, Stephen, but I think, obviously the context of the energy crisis, the energy price crisis, the war in Ukraine, what's happening with, on the gas side, that forms the backdrop to this. So do you think, the current problems, if they are problems in wholesale markets, are truly perennial, or will they become less important even without interventions after the next winter, say maybe from spring 2024?
Well, again, I don't see the problems are problems with the markets. But if the old truth is that markets have winners and losers. And the basis of our internal market for energy is that there's a lot of sharing going on. And in times of plenty, people are willing to share, and it doesn't seem to have great downsides. And once things look tight, whether that's in terms of the cost of energy or even the availability of energy, the elbows sharpen and the desire to cooperate goes down. Now, this is not new. One of the first projects I worked for when I joined what is now Afry 20-odd years ago was the North Sea Interconnector, a project between Britain and Norway. And that project founded on concerns that it would drive energy prices up in Norway. Those concerns haven't gone away. Indeed, we've seen Norway pass legislation, I think, that restricts exports at times of physical scarcity. And we're seeing a lot of concerns about the consequences of selling your neighbour's cheap energy and putting your own prices up. So I think that political tension and the tension between national interests and the Commission's view of collaborative enterprise, I think, those tensions are highlighted by today's circumstances. I don't see them as market failures, but it is about the distribution of benefits, and there will always be tensions over that when there's not enough to go around.
Finally, Stephen, if I could grant you one wish for the Commission and its proposals after this consultation, what would that be?
Stick with the market's view.
Excellent. Stephen, many thanks for joining the Montel Weekly Podcast. A fascinating discussion again.
Richard, lovely to talk to you. Thank you for the opportunity.
So, listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or, let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify or wherever you get your podcasts from. Thank you and goodbye.